China's exports plunged 7.5% year-on-year in May, according to the country's Customs Bureau. That's the biggest fall since January. The figure is just the latest sign that the world's second largest economy is struggling to reboot after its pandemic-induced slowdown.
China's exports figures have long been a bright spot for the Chinese economy. But that may not be the case this year. The Commerce Ministry says slowing external demand and the rising risks of a global recession are posing the biggest threats to the country's economy. China's exports have fallen from more than $350 billion in March to nearly $284 billion in May. These numbers are just one indicator in recent weeks that point to a slowing Chinese economy with falling industrial production, profits and credit growth. Trade with neighboring Russia, on the other hand, has soared to levels not seen since the beginning of the war in Ukraine. They exchanged goods worth $20.5 billion in May. China's imports from Russia were worth more than $11 billion, which means sanction-hit Russia has a trade surplus with China, mainly exporting oil, gas and coal. Beijing says it's a neutral party in the Ukraine war, but has been criticized by Western countries for refusing to condemn Moscow and for its close ties with Russia.
Well, I've been speaking to our China analyst, Clifford Coonan. I asked him why China had seen such a big drop in exports.
Well, I think it's basically all down to weak global demand. That's the sort of the headline reason. It was indeed a big decline, much worse than anyone had been expecting. Even the more bullish people on the Chinese economy hadn't expected the decline to be so strong. I mean, I think the European exports from the EU to the EU fell nearly 39%, which is a staggering amount. And basically what you've seen is a sort of, first of all, there's a normalization. A year ago, we were coming out of the pandemic. Shanghai had just reopened, and we saw the impact of that, whereas other markets were still closed, still feeling the pandemic. So in some ways, it's not as bad as it looks. But overall, the problem that China is dealing with is this weak global demand, which means there just isn't the demand for the exports. And that's ultimately the challenge that's facing China right now.
Is this something that Beijing would have been expecting when, it announced that reopening at the end of last year? Or was it expecting a more sustained growth in exports?
I think there was a feeling that everyone was expecting a boost, that there was going to be at least a month or two, a few months of recovery, and that maybe things would even out. But I don't think anyone expected things to fall 7.5% year on year. I mean, that's a significant drop. So I think it's worse than everyone was expecting or indeed hoping for.
And it's also worth talking about imports as well, because they're well down from South Korea, Taiwan, over 20%. So I mean, what's driving that? What's not being imported from those countries? Electronics, presumably.
A lot of it is electronics. One of the things that happens with Chinese imports is, in a way, that they're part of the export cycle, in that they'll import things like screens, keyboards, microchips, of course. They'll then turned into mobile phones or PCs or laptops or whatever, and then exported again. So it's kind of feeding into a cycle, which means that we're probably not expecting a major recovery in the coming months in exports, because the import figure is also pretty grim.
Oh, that's interesting. So there's two things that, they're very closely linked to imports and exports. And actually, it's almost as though China can't be importing an awful lot and not also exporting an awful lot, and vice versa.
Well, that's right. It needs to import these components for finished goods. It's also what people from Europe and the US are looking at. They want China to import things like luxury goods. The luxury goods industry now is so reliant on China, and they were hoping that at the end of the lockdown they would get a boost, and indeed they did. And in some ways, consumer spending hasn't been as bad as some other areas, but still, this is a sign that maybe they won't get a sustained boost in luxury goods. I mean, the immediate reaction, you saw stocks like Hermes, luxury brands, they fell after the news. So clearly, they weren't expecting such a big decline either.
The growth target that Beijing set of 5% for this year, I mean, seemed modest at one point, but increasingly seems unlikely. I mean, what is Beijing doing to try and increase growth?
Well, I think what it has to do is focus on the domestic economy. That's all it really can do. It can't really do anything about global growth. So what it will look at, one of the areas that has been underperforming has been the small and medium-sized enterprises in China. They're the ones that manufacture the goods for export. So what they need to do is they'll look at stimulus. The government will be looking at ways to get the economy going again. They can't really do much about consumer spending. It's very difficult to stimulate consumer spending. You can get a very short increase, but ultimately, particularly with interest rates being what they are, you know, people are sort of are loath to really start consuming, and the economy is weak. So what they're going to do is instead some form of corporate stimulus. For a long time, we've seen sort of political reasons why they've been going after things like the tycoons and the tech sector. But I can imagine that'll be put on the back burner now because they need the tech sector to start growing. They need the small and medium sized firms to keep growing. So they'll come up with some form of stimulus measure to give them a boost.
One interesting part of the story is that China's trade with Russia remains strong. Why is that?
They're very strong and they've increased. One of the reasons is that oil and gas isn't covered by Western sanctions, that China can import cheap Russian oil and gas now because obviously they're getting a very good price without incurring sanctions from the West, and they're taking full advantage of that. I think a lot of the figures are down to things like oil and gas. Other than that, there's other components, there's other aspects that aren't covered by sanctions that are being imported by China. As they've said from the beginning, these are two allies, and China has taken a very sort of neutral approach to Russia's invasion of Ukraine. So in some ways, this is kind of reaping the benefit of that alliance.
OK, Clifford Coonan, our China analyst. It's always fascinating to speak to you. Thanks again for bringing us your insights.